You know December is supposed to be calm? This year, markets finally caught a breather. The Fed started easing off the brake, and a handful of new rules just landed that'll shape how we save and invest in 2026. Hi, I'm Werba Rubin, a partner at Werba Rubin Papier Wealth. Let's unpack what changed and what could it mean for investors. First, the Fed finally blinked. The Fed began easing with a 0.25% rate cut in mid-September and has signaled room to move if the labor market keeps cooling. Futures and economist surveys currently lean toward additional trims to year-end, with the policy ranging from around 3.75% to 4% by the end of the year. Second, yields are down and bonds finally feel useful again. When the 10-year Treasury slipped below 4%, bond investors finally exhaled. For most of this year, bonds were the boring kid at the party. Now they're quietly doing their job again by producing income and stability. For those holding mostly short-term cash, the recent rate changes highlight why having a mix of maturities can help balance income and stability. Third, stocks are finishing the year strong, but not evenly. After one of the best Septembers in over a decade, large-cap U.S. stocks powered higher, helped by AI enthusiasm and that rate cut. Underneath it, though, you saw rotation, as smaller companies in international markets were choppier. After a strong quarter for large cap stocks, it's a natural time to review your allocation and make sure it still aligns with your goals and risk tolerance. Fourth, oil prices cooled, and so did inflation pressure. Crude slid to multi-month lows this fall, and cheaper energy filters into everything from transportation to food prices. Lower oil isn't a guarantee, but it's one more sign the inflation story might be coming to an end. Translation, the backdrop heading into 2026 is less fight or flight and more fine-tuning plan. Fifth, now the rulebook has changed too. Let's hit the highlights. First, Roth catch-ups are officially coming in 2026. Starting in 2026, individuals over 50 earning more than about $145,000 will need to make 401k catch-up contributions as Roth contributions. It's worth checking whether your plan includes Roth option and the payroll's ready to handle those contributions when the rule takes effect. Second, the IRS dropped 2026 tax brackets and HSA limits. If you use HSA or year-end tax planning, take a look at the new numbers so you can adjust contributions. It may be worth confirming that your plan includes Roth option and that the payroll systems are prepared when this rule takes effect. Third, California extended its pass-through entity through 2030. If you are an S-Corp or partnership owner, you can keep using the PTET election to offset the state SALT cap. Business owners should be aware of quarterly estimate timing since the PTET election deadline can approach quickly. And last, auto-enrollment is officially marching forward. Starting with plans set up in 2025, most new 401ks and 403bs will have automatically enrolled employees with built-in deferral rates and annual increases. It's a win for participation, but it means employers need to lock in defaults now, not later. This year ended quieter than it began, but under the surface, things are shifting in your favor. Rates are softening, rules are modernizing, and investors have more planning tools available than ever. The opportunity isn't in predicting what the Fed does next, but in positioning your finances so you don't have to. We'll be back in January with a full 2025 outlook, but for now, you can celebrate the wins and go into the new year feeling prepared. What's on your radar for 2026? Let us know in the comments, and we'd love to hear what you're planning for.